Welcome back to the Project Management PrepCast. This is part 2 of the lesson on project finance principles, where time is money, and the sooner you get your project management certification, the sooner you can ask for a raise. I'm your instructor, Cornelius Fichtner. As a reminder, in part 1, we covered a high-level discussion of what finance principles are, along with some examples. And now in part 2, we discuss the time value of money. In part 3, we continue with some forward-looking tools, such as the return on investment and the project manager's responsibility. It's time to get this show on the road. First, we need to understand the concept that the value of money is not static. Assume that for your birthday you get $100. You can leave that $100 under your mattress for safekeeping, but it buys less in the future than you can buy today. So this may not be the best idea. This is based on the concept that inflation devalues the euro, dollar, rupee, franc, peso, dinar, ruble, krona, pound, shekel, or whatever your currency happens to be. It will be worth less in the future. Deflation, where a currency gains value, that can happen. However, it is rare. Usually the worst place to put your money is really under your mattress. It seems safe there in most cases, though. You can invest it, even if only in a bank account, and increase its value faster than inflation eats away at it. The higher the risk, the more likely you will get higher returns. Fundamentally, time value of money means that a certain amount of money in the present, today, has a different value than receiving the same amount of money in the future. Let me ask you a question. Would you like to be given $100 now versus $100 a year from now? Which one would you pick? Consider that if you had the money today, you could invest that money today. Your $100 today would be worth a bit more a year from now. Given a choice, you should select to get that $100 now instead of waiting a year to collect it. The obvious question is, of course, if I have $100 today and it's not the same as $100 in the future, then how much is the $100 that I have in my wallet right now going to be worth, say, a year from now? In this case, we are looking at the future value, FV, and this should be intuitive to you. Your money today will change or grow according to the rate of interest. If you are looking for the future value of your $100 a year from now, and the interest rate is 5%, well, you multiply that by 1.05, and that equals $105. Ergo, $100 today is worth $105 a year from now because of the rate of interest. The concept of present value and future value is based on the assumption that money can be invested in bank accounts and get positive interest. Therefore, the assumption is that future value is always greater than present value. Let's start with present value, where we would ask, if I need $100 a year from now, how much money do I need today? Well, if you think about it, you would have to discount or decrease the $100 in the future by the expected interest rate. In other words, what money do you need to invest now at the current interest rate in order to have $100 a year from now? If we assume the interest rate is at 5%, then we know that 100 equals present value divided by 1 plus 5%. Solving for present value equals 100 divided by 1.05 or 95.23. In other words, if you had $95.23 today, you can put that into a bank account with 5% interest, and in a year you will have $100 exactly. Of course, any investor knows actual performance may vary, which is another way of saying that all investments carry risk. Present value and future value is actually one of those areas that you may have to calculate on your exam. Our previous example was very simple. We only considered a 1-year time frame. So here is a more rigorous formula to handle multiple years. Present value encompasses the concept of today's value of future cash flows. And here is the formula. FV equals PV times 1 plus R to the power of N. Said in non-mathematical terms, to determine the future value, you multiply the present value by the compounded interest. And the compounded interest is really what the power of n part of the equation is saying. And you can use the same formula also for our previous present value example where we just had 1 year. All you have to do is say n equals 1 as your time period and you're good to go. So what does all of this mean in terms of the abbreviations? Well, PV is the present value, as you would have guessed. FV is the future value. R, that is the annual interest rate in decimal format. And N is the time in years. It's a bit more complex of a formula, but it makes sense when you break it down into its constituent parts, and it will make sense once you've used it 2 or 3 times. Here's an example for present value calculation. Assume that we need a future value of 1 million. The annual interest rate is 12%, and the time that things would be invested is 3 years. Now, with a little algebra, we can take the formula from future value and figure out that the formula for present value is FV divided by 1 plus R to the power of n. So, if our future value needs to be 1 million, we divide that by 1 plus the 12% interest rate to the power of 3 for the 3 years of investment, and the result would be that we need a present value of 711,780.25. However, if we invested 712,000 in a bank account today, we won't make our million because bank accounts simply don't pay that high of an interest rate, 12%. Come on. More likely, you'd have to invest this in risky stocks that may pay up to 12%. We can see the time value of money in action because we can plot our present value of $711,780 and watch it grow to the 1 million in 3 years. We see that in the first year we earn over $85,000 in interest, and if we round out the numbers, we have almost $800,000 as a balance. As the balance grows, so does our interest. In the second year, you earn over $95,000 in interest, which results in a year-end balance of nearly $900,000. And by the end of the third year, interest for the third period is even higher. With over $107,000 in interest, we get to our target future value of exactly $1 million. Well, what does this mean for our projects? Well, maybe some projects can save money. However, most projects spend it. For that, we look back at our example of building the data center, where we had a choice of build versus outsource. Here are the parameters around the project. First, here's the option to build the facility themselves. The first year cost would have been to construct the building, staff it, and pay for power and data services. But they had also forecasted that the building would bring them new business because the community would be impressed with what they were doing. And that would offset some of the cost by $180,000. So the total first year cost was $1.579 million. For outsourcing, though, on the other side, a lot fewer numbers, the first year costs were also a lot less. Setup and the service and management fees only came to $654,000. Now, assume that they had planned on using cash, regardless of whether the decision was to build or outsource the data center. This means that the difference in cash outlay would have been, the build option minus the outsource option, $925,000. If you calculate the future value of that cash, $925,000 at 5% interest, remember this is only for 1 year, you get a future value of $971,250. Because they did not get a chance to earn interest on that cash, there was the opportunity cost of capital involved in the decision to use cash to build the data center. However, if that cash could have been used to do something else that generated a moderate profit, the outsourcing option would have surely been better from the start. Remember, in our example, that the economy has issues and that the executives had you double-check everything in the middle of the project. Leaving out the cost of money in the initial comparison of options could have been a big mistake. Of course, that was only the cost for the first year of operation. That cash is used and will not be drawing interest until it's paid back. If we do the same calculation for each of the first 5 years, we can see that it is not until the 5th year that the use of the cash finally pays off. In that year, we would have finally paid more on outsourcing than on the build and operations. These type of calculations, they can get involved, and this here is only a simple example. An analogy I want to make is that future value and present value are like apples and oranges. What do I mean by that? Well, basically a present value and future value, as the name implies, they are in different time frames and cannot be directly compared, added, or subtracted. So what do? No, you don't make a fruit salad. Instead, you simply have to ensure that all values have the same time period before comparing, adding, or subtracting them. Usually they are converted to present value. Therefore, its alternative name, present discounted value. An example may help. Say you had to find out the combined value of two projects. Project A had a future value of 1 million in 3 years, whereas Project B had a future value of 1 million in 5 years. You might now be inclined to simply add them together and get 2 million. However, you can't do that until the values are in the same time frame. First, you have to select a time frame and then convert the numbers to that time frame. You could figure out the future value of each project in 3 years from now and then add those two values, or you could calculate the future value of each project 5 years from now and add those two values, but more likely you could compute the present discounted value on the projects and add these values together. And this takes us to our next topic, which is net present value. This is, of course, very closely related to the present value. Net present value, NPV, is a standard method for financial evaluation of long-term projects, used for capital budgeting and employed widely throughout economics. Net present value measures the excess or shortfall of cash flows in present value terms once financing charges are met. Here's the formula for net present value. It's a bit scary looking. Net present value, NPV, is the sum of present value of cash inflows minus present value of cash outflows. There is no need to remember this because you won't actually have to do any NPV calculations on the exam. Well, isn't that great? Instead, you need to know this. When NPV is greater than 0, the investment is profitable and the project should be accepted. When NPV is smaller than 0, then the investment is at a loss and the project should be rejected. And when NPV equals 0, the investment amount is neutral. You need to look to other indicators to see if you should actually do the project. And, of course, if you compare the NPV of two projects, all else being equal, then the project with the greater NPV is better. Again, you might ask, how does this relate to my project? Well, since large number of projects are not designed to make money, it may not actually relate to you. Again, an example is probably the best way to understand how NPV works. Here we use a very simple example, which assumes simple cash flows. We do not calculate interest and the time value of money. So, assume your project is to build and sell custom houses. You have your project structured so that at certain times and certain points in the project you get money for the work you have done. Say you get 10% at the start of the job, 10% after grading, 30% after framing, 40% after finishing, and 10% on completion of the landscaping. And then lastly, This house has a selling price of $200,000. Now, with this data, you can track your net present value at each stage of the construction. As you start the job, you have to hire people, get licenses, pay an architect, and put deposits on the equipment. That costs you $10,000 and you're paid $20,000. Your NPV is $10,000. While getting ready to do the foundation, the weather gets bad and the rain turns the site into a muddy mess. Equipment gets stuck, the progress slows, and your costs soar. Expenses get to be $30,000, and you are only paid $20,000 per the contract, and your NPV for that stage is now negative $10,000. The rest of the project goes well, as you can see by the numbers here in the spreadsheet in various places. When the house is complete, your total out your spreadsheet and the net present value comes to $50,000. That means you made a profit. It should be obvious in this particular example that the larger the NPV is, the better, because it translates directly into profit. That is why most of us work. So, as a rule of thumb, all things being equal, when you're choosing among different alternative projects, follow the NPV decision rule, which basically says you should opt for the project with the largest NPV. The bigger the NPV, the better it is. The NPV is equivalent to the cash value today of your project. So always select the project with the largest NPV. We better take a break and rest our brains. Here are some takeaways from part 2 of this lesson. Money and time are closely related, and the value of a given amount of money decreases over time. Because of this, the value of money today cannot be compared to its future value. It needs to be adjusted to common timeframes. Most commonly, that is to the present discounted value terms. And with that, we conclude part 2 of the Project Finance Principles. Until next time.